Another day for Nasdaqistan, Trump tweets, and April Fools. Yeah, um, we've been getting completely rage baited in this market. There's nothing else we can really say. But today we're gonna be going over something that ICT has mentioned very recently, like last year November, something like that. Identifying algorithmic PD arrays. Okay, for a specific trader. Now, you only have three types of traders. You got short-term traders, which is basically day traders, swing traders, and then kind of sort of long-term traders, which is holding trades over like more than 2, 3 weeks, months, and stuff like that. So, if you use ICT and you are a day trader, for example, what you'll be looking for, how you mark your arrays, or how you find your most algorithmic arrays for just reference and respect and stuff like that, and basically points of interest and points of reference, you'll be using the first 20 days or the first 20 days going back. Okay, so casting back. Well, no, what is it? Is it called look back or cast forward? No, it's obviously look back. So looking back 20 days from the current day, which is, I guess you can go to the daily and say today. So here you go. Today, where is my vertical line? Today, and if you draw back 20 days, like so, that would be the short-term range for IPTA, okay? If you watch the IPTA video I posted, you already know what I mean by this. This is the short-term range of the interbank price delivery algorithm. So everything in this range is short-term or meant for day traders like me and you. Because I'm teaching how to day trade. You can obviously apply these concepts to what's the word? To higher time frames if you wanted to, or if that's just your preference of trading. Yeah, of course. But for me and you, what you're likely going to be doing is using the 20-day. If you are a swing trader, 40-day. Draw that out. 40 days, bang, just like that. And obviously, if you are a long-term trader, 60 days, going all the way back here, or as close as you can get to 60 days, which would be 61 days. Let me drag this down because it looks a little weird. I don't like my drawings to be looking weird. So let me just pull it down real quick. Hold on, if I can get it up. There we go. That looks decent. Okay. Now we're mainly going to be focusing on the 20-day part because we're day traders. We're not going to be looking 60 days back unless we're actually using the if the data shift. But identifying algorithmic PD array. So let's actually have a little drawing there from when I was explaining. No, I didn't mean to, I didn't mean to do that. I meant to delete this. But let me get this out of the way, and now here we go. So just looking here, all we're going to do is simply identify arrays. That's it. We're just going to identify them and draw them out and see how price actually respects them in a kind of sort of algorithmic way. Now we have this gigantic, when I say gigantic, I mean gigantic volume balance, which is 220 points wide. So dragging that out, we can see that price hits that level in which the volume imbalance is large enough to apply equilibrium and quadrants to it. So if I can get it, there we go. Look at that. Look at that. Now, remember how I said volume imbalances? This is just the volume imbalance confluence by itself. But including the 20-day range, you can see that price hit this volume balance, got super close to the equilibrium, did not reach it. Well, what does that mean? It's a good thing that price wants to respect that. Yeah, that means price wants to go lower. It wants to keep going down. So this is a good thing that it did not hit the equilibrium. Now, that's the algorithmic part. I said park. Algorithmic part that I'm talking about. The fact that it reached up into this volume balance, right, and did not hit the equilibrium on purpose. That's the identifying algorithmic arrays that I'm talking about. Because if you are day trading, right, and you go 40 days out, it's pretty likely that the algorithm is not going to be referring to that and respecting it on like it may seem weird to explain this, but like if you're trading on the 1 minute, 15 second, 30 second stuff like that, right? You're not going to see an array that's I don't know 47 days old getting respected on that time frame. If you get what I'm saying, I can't really fully explain it because all the time frames are in sync. Like all the time frames are printing the same price action, but live in the charts, like you're actually seeing price move on that 15 second and that 15 minute, not 15 second, but the 1 minute time frame, and you're down there. You're not going to see price reference that array. You're just not. You might see it do it based off of the strength of the array, but since it's not a short-term array in the form of how old it is, basically, you're not going to see price really algorithmically reference it as much. But since we're doing short-term trading, me and you, we're day trading, we're going to be using the 20-day. So looking at this, let's see, is this a propulsion block? No, not because I didn't break that. So no, this rather would be a order block. So this entire order block here, from here to here, we draw that out. You can see price is to equilibrium. once, hits the lower quadrants, 1, 2, and guess what? This is the algorithmic part. I said park. It's these stupid things that are on my teeth. I can't talk properly, but the algorithmic part that I'm talking about is look at how the body's closed below each of those levels. That is absolutely amazing, beautiful. Now you're probably like, what is that? Well, body? What does that mean? According to the algorithm, now that was a very long pause, my bad, but according to the algorithm in its code, the bodies tell the story in which the body tells you where price truly wants to go, in which the wick just does the damage. Or if you want to put it into simpler terms, the bodies tell you the bias, the actual direction, but the wicks just tell you where it referenced, okay, or what it referenced, or and how it's referencing it. But that body closure is going to tell you which direction it wants to go, in which clearly how we're looking, it obviously wants to drop. And does it drop? Yeah, yep, it it definitely does drop. Now, what would this be? A propulsion block, right? Yeah. Did it break below that? Yes, it did. Now let me basically drag this quadrant down or delete it and create a new one at this propulsion block here because it was the deepest up close candle that reached into that order block previously. Looking here, we can see just look at how algorithmic this is. Probably like, oh, you're just throwing that word around. Oh my God, no, just actually pay attention. This is not random. Price drops down right here. Bang. This is within the same day of Thursday, March 26, 2026. We drop down, go below that order block, activating it. How far do we go below it? Let's see, from here to there. That's 10 points. Is that good enough for you? 43 ticks below that. People are like, oh, but it's not like 3 or 1 ticks. So I'm not going to consider it algorithmic. This is on the daily. This is on the daily. With this right here, if I draw that again, just looking from it scrunched down like this, not even scrunched down, but just looking at it normally, that is what it looks like. So I'm not just necessarily throwing around this word. I'm not necessarily just using it all the time, but I'm saying it because this is not random. We come down here, don't even go that much past it. We activate the order block. We reference up into it just a little bit. We draw back up into it. Then, listen here. This next candle, we close in, well, not close, but open inside the, what is it, the order block, jump up, hit the order block's body, which is a more sensitive point of the order block. The entire order block itself is where the quadrants are be applied, but you can use the body as a more sensitive point. Like you can see the actual wick of the order block get tapped into, and then you might say, oh, if it respects the body of the order block, then you might be like, okay, I'm gonna actually accumulate positions. I said positions. I can barely speak, but accumulate positions at that body or when it respects the body, in which it reaches up into the body right there, drops back down below it, and keeps dropping. Yeah, it keeps dropping. You're probably like, well, why are we using the body specifically of order blocks? If you don't know, which I've said this hundreds of times, by the way, order blocks are one of the most institutional, okay, listen to me here, one of the most institutional and algorithmic arrays that we have. Reason being, the interbank or smart money, which is me and you, are directly interacting with the algorithm at all times. But if we're talking about the big money, which is millions, billions, hundreds of billions, stuff like that, which is interbank, the primary array that they use to accumulate or distribute their positions is order blocks. So, since they're actively working with the algorithm, because remember, the algorithm is constantly offering opportunities to accumulate positions, close orders, accumulate more positions, and stuff like that, the algorithmic part of the array is what? The body. I just told you that. Just earlier, I was explaining it up there. So, if we know that the body is the algorithmic part and the order block is the most institutional array that we have because this is where they accumulate most of their positions. Don't you think when price reaches up into or the algorithm references that old body, so it's referencing its old algorithmic footprint and saying, okay, institutions, are you going to long here? Are you going to short here? Are you going to close positions here? What are you going to do? In which the interbank is obviously going to accumulate more sales, in which price dumps and it drops and it drops. Get the point? It's pretty simple. Now, I would recommend using the 20-day range on, let's see, the daily and 4 hour. That's why I'll say you would look for your raise within the 20-day range because if you go to the hour, you're basically on short term now. It doesn't really make any sense. But I'll say the 4 hour to daily for the 20-day range would be perfect. For the 40-day, I would say daily to I think daily, specifically for 40 days, good. And then for 60 day, obviously it would be daily and weekly. Possibly monthly, but I think that'd be a little too much. So there you have it. There's your parameters for all the algorithmic array ranges, or basically just searching for algorithmic arrays, in which I just showed you the algorithmic functions of those arrays just now. So hope you enjoyed. This is the end of identifying algorithmic PD arrays. If I can speak in the video off. Until I see you in the next one. Good luck and good trading.